Our October preliminary read on durable good orders expected to be down 2.6, 2.7, worse, down 4.4%. Now, this is preliminary. If we strip out transportation, it improves dramatically to up 0.1. Also much less than expected. If we look at capital goods orders, non-defense ex-aircraft, a proxy for business spending, capital investing, what we see there is unchanged. We're expecting up 0.2. If you look at shipments versus orders, that was up 0.3. First time in this series that was as expected. A little activity in the options pits. If we look at jobless claims, they moved from 221,000 up 3 to 224,000, and of course 221,000 was revised. Originally released at 216 last week, and 1.668 million on continuing claims. That's just a bit lower than our 1.67 look. As I look up at the board, we drifted maybe a basis point on 10s. These were actually somewhat weak durable goods. As I said, they can be revised. And we still have much more data to come. We'll have our final read on University of Michigan, leading economic indicators, existing home sales, dollar index giving a 1/4 cent back of that pop yesterday. Remember, there's only been 2 closes above 97 going all the way back to the summer of 17. One of those is the high, obviously, at 97.54. We're not that far away, but giving up a little ground. Andrew, back to you.
Thank you, Rick. Steve Liesman, you have been talking about the importance of these numbers all morning.
Well, let me see if I can get into it. There's a lot going on here. The first thing that sort of hurts the top line is Boeing. I mean, it says the line is non-defense aircraft and parts, right? AKA Boeing, down 21% after falling 19%. I don't think Boeing is having a problem selling planes. They're up. What's the year? In August, they were up 20%. Another thing that's kind of like it was up 63% in August. So it's a volatile series that they sell a lot of planes 1 month or whatever it's accounted for. The other thing that's in there is defense aircraft and parts and defense capital goods. Those are both deeply negative. But I don't think there's any story out there about the U.S. government stopping or slowing down. I think the story is the opposite. They're increasing defense spending. So that reverses itself. So let's get rid of all that stuff and look at what's happening in the private sector. And there it's more mixed. Electronic appliances up 2.9. Communications up 3.2. Computer electronics up 1.6. Primary metals down, general machinery down. The number that is the most troubling to me here is this unchanged business investment number. The business investment says non-defense capital goods, ex-aircraft business investment. That's unchanged. It's the third monthly, month-to-month decline in a row. And it raises the question as to what is happening in the capital spending. We're supposed to be getting a boom here when it comes to it. It may be that it's a pause. Right. It may be that they're waiting for next year to spend, but we know we've had the tax cuts. We know we've had deregulation. We know we've had a lot of things. There should be some kind of kicker here to CapEx. It was a real disappointment.
I want to talk about the CapEx, because there's been a big debate about when the CapEx is supposed to kick in or not. Right. By the way, St. Louis Fed was suggesting that you wouldn't actually get the kick the way we saw that somehow we're going to see that come in 2019. Does this suggest to you that you would have wanted to see, I think, a little bit more of a trend moving?
Let me try to tell you neutrally 2 theories of the case. Okay. One theory of the case from the administration here was that one of the things that kept capital spending from accelerating was the tax rate, the relative tax rate, and that by lowering it, you'd get a kicker. The other side of that story was that you did not have a lot of demand out there that was unmet by capital goods. Right. You did not have a lot of investment projects that weren't happening because of taxes. And there was not much really to be done here that lower taxes would kick in. The current data kind of favors the second one. But I think it's still time. You still want to give it a little more time before you say there is going to be no CapEx boom. I think we want to see what happens with budgets for this year. We want to see what happens early into next year if it does kick in. I think it's unavoidable there will be some kick. I think it's inevitably going to be less than perhaps the administration has projected. And then